Hi, I'm Grant Stephen.
And I'm Kris Bernier.
And we're the Two Investment Guys. This week, Kris and I are going to turn back to the markets and talk about some of the things that we're seeing there. You know, when we look around the indice returns, we've got Toronto up about 4%, Kris, and the S&P 500 in the States is up about 11%. Those European markets and Asian markets that we talk about are up anywhere from 7% to 20% in the case of Germany and in the case of Tokyo. So, you know, clearly markets have moved higher, Kris, but interestingly on lower volume. The news flow has subsided a little bit lately, and as well, you know, here we are 5 months into a rally. We've got a bit of a pause going here, and I think that's important. But the most significant event that Kris and I have seen is a rise in bond yields. And Kris, what does it all mean?
Well, if we take a step back over the period when Europe was really in crisis and dominating the news flow, we saw 10-year bond yields in Canada and the US bumping along a 30-year low. And most recently, as equity markets have risen, we've seen bond yields rise and actually break up to the outside. So 10-year US Treasury sitting at around 2.3% off of about a 1.85% low, so a fairly significant move. And what we believe is going on is we've seen since 2008, 2009 a very strongly supported rally in the markets, a rebound that's been supported by the central banks around the world. And that's continued right through until even with the European situation last fall. Now we're starting to see a transition to where the central bankers are trying to push the sustainable recovery back onto the economy itself. And we think that's where we're at, where things are now.
Yeah, I think that's interesting. It's sort of like the mother is passing it off to the child, and the child can now run with it a little bit, that things are more stable and certainly improved to where they are. You know, Kris and I have dug around and we've always talked about the yield story, and we found some very interesting statistics around dividend yields. And for instance, the S&P 500 is now at a 28% payout ratio for dividends, Kris. That's the cash flow that's available to be paid out in dividends. So 28%, that's the lowest rate in over 100 years. So we'll take that a step further and we'll say, well, what does that really mean? And it sort of means that these businesses are in a protective type of mode for their balance sheets. And so the cash is staying on the balance sheets and not being reinvested back in the business. What can they do with it? Well, things like mergers and acquisitions, or M&A as we call it, share buybacks, and dividend increases. So that divergence has never been greater, Kris, than we're seeing right now.
That's right.
What does that mean?
And that's a good example of that is what we saw Apple do recently. First time they've paid a dividend since the mid-90s. You should talk to your advisor about the dividend story again and what rising bond yields might mean for your portfolio. We want to thank you again for your questions and comments. If any of the topics we discussed today are of interest to you, give Grant a call or contact us at TwoInvestmentGuys.com.
Join us next time. We're going to continue talking about the markets. We're going to follow up on the yield story a little bit and the importance of the demographics that are at play as well in terms of chasing yield in the markets. So until then, I'm Grant.
And I'm Kris.
And we're the Two Investment Guys.